This is Nightly Business Report with Sue Herrera and Bill Griffin.
Lucky 7. The Dow notched just 7 straight weeks of gains, even with lingering concerns over trade and growth.
Hanging in the balance, Amazon is said to be reconsidering putting its second headquarters in New York amid a wave of local opposition.
Price of admission. One university's plan to offer free tuition in exchange for a percentage of your future income. Those stories and more tonight on Nightly Business Report for Friday, February the 8th.
Good evening, everyone, and welcome. Stocks got a late day lift to keep their weekly win streak alive. This came despite a rise in investor nervousness and lingering concerns over trade, global economic growth, and a slowdown in corporate earnings. Those fears dominated most of the day's trading and resulted in a mixed finish for stocks. The Dow Jones Industrial Average was down 63 points to 25,106. The Nasdaq added 9, and the S&P 500 gained 1. All of the major indexes posted small gains for the week. The Dow is now up for 7 straight. Bob Pisani reports tonight from the New York Stock Exchange.
Fears over the U.S.-China trade wars fueled a lot of today's declines. First, the Wall Street Journal reported that the two sides not even have a trade deal drafted yet ahead of the crucial March 1st trade deadline. That put global trade-related names under pressure. Industrials like Boeing, Caterpillar, semiconductors like NVIDIA, and Taiwan Semiconductor. Those stocks also traded lower after Goldman Sachs warned that chip makers looked expensive, as demands for memory remains very soft and prices continue to decline. But around 11:45 a.m. Eastern Time, CNBC's Eamon Javers reported that a senior White House official told him that the key March 1st deadline on trade could very well be moved. That news lifted stocks right off the day's lows, but there still wasn't a lot of buying volume behind the move. Finally, another big red flag has been earnings. Earnings growth has turned negative for the first quarter. That's the first time we've seen growth estimates dip below zero since the second quarter of 2016. Keep in mind, earnings growth for the full year, 2019, still positive, but even that is slowly trending towards zero, thanks to slower global growth and rising raw material costs. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Matt Maley joins us right now to talk more about the markets as we head down the road here. He's equity strategist at Miller Tabak. Matt, thanks for joining us tonight. Good to see you again.
Great to be here, Bill. Thanks.
When we started this day, we thought we were 3 weeks away from the deadline to get a trade agreement with China, but now we hear that deadline may move. What does that do to the markets, do you think, and their expectations?
Well, you know, the market did bounce back when that news started to filter through the Wall Street here. But the one thing that concerns me is that it's just we've created a situation again, I think, where the uncertainty over this issue is going to be with us for quite a while. It just because listening to what the people, real insiders are saying, and especially the geopolitical experts who really look at what China has done in the past. And they're saying that this is going to be something, this intellectual property issue is not going to be settled for quite some time, many, many months. So even if we get a small deal, or even if we kick the can down the road a little bit with a small deal and push the 25% tariff increase out several months, it's going to be a while before we have any kind of definitive agreement on this. So I'm very concerned about it.
And the one other thing that is very real is economic growth globally is slowing.
There's no question. I mean, one of the things we saw in the second half of last year is that people were hoping, well, geez, Europe has really turned down, but maybe the worst is behind us, and we'll get a kind of a trough growth in Europe and in Asia in the fourth quarter. And obviously, with the estimates coming down just in the last couple of weeks and growth slowing, especially in Europe, it looks like we're going to be that the worst is not behind us, and we start to worry about, geez, is the U.S. going to hold everything up, or is it going to follow the rest of the world down?
Before we let you go, you're starting to scare the kids here. Are you worried about our market here in the United States right now as a result of all of this?
Well, I am a little bit, but it's, again, I'm more cautious than bearish. I just think after this, 16% rally in just 5 weeks, we need to take a little bit of a breather here. And with the Fed on the sidelines, but not adding quantitative easing, we have to look at the fundamentals. And with them looking a little bit weaker going forward, I think people want to avoid chasing the market up here and looking to buy on weakness rather than chasing on strength.
Very good. Matt Maley with Miller Tabak. Always good to see you. Have a good weekend.
You too. Thank you.
And now to one of the most valuable publicly traded U.S. companies, and that is Amazon. It is said to be reconsidering its plan to open a second headquarters in New York City, a proposal that was expected to bring 25,000 jobs to the area. As first reported by the Washington Post, executives had internal discussions to reassess the situation, which has been met by local opposition. And today, New York Governor Andrew Cuomo pushed back, saying New York needs Amazon and that the incentives offered make sense.
You know what the incentive package was? We get $27 billion in revenue. They get $3 billion back. We get 27, they get $3 billion back. I would do that all day long.
We are joined now by Scott Cohn, who, as you know, has been covering this story for us all along. Scott, it's great to see you. One of Amazon's main criteria for this new headquarters site was a, quote, stable, business-friendly environment. Did the company miscalculate New York, or did New York maybe misrepresent itself?
Well, it's hard to imagine, Sue, that New York didn't put its best foot forward, maybe put a rosy picture on things. So maybe there's a little bit of that. But on the flip side, it's hard to imagine that Amazon, with everything that it knows about all of these cities that bid for this project, didn't realize that New York is a big, diverse city. It's a union town, and that it was going to hit some speed bumps potentially in actually closing the deal and getting this facility in Long Island City, Queens. So a little bit of both, and there's also no doubt a fair amount of posturing here on both sides.
Right.
This is bargaining that's playing out in public.
Exactly. But assuming that they do end up going someplace else, you have visited all of the other possible locations that Amazon was considering. If it's not New York City, who do you think it might end up being?
Well, first of all, let's be clear that Amazon is not saying that it is pulling out,
right.
But certainly there's talk about maybe entertaining that option. If anybody knows all the different options available, it's Amazon. Remember, there was 238 cities that bid on this project, 20 finalists, so the company knows all of that and knows all of the data. But at the same time, it doesn't realistically have a whole lot of options, because remember, they couldn't ultimately decide on one place, reportedly because there weren't enough workers, high-tech workers, to fill all of the jobs. So they may have to stay in New York, and one option for them is to do things kind of the old-fashioned way, and that is to pay for it from themselves. Don't give up control to New York by taking the subsidies. This is, after all, about a $180 billion a year company that's haggling over $3 billion in subsidies, so they could do it that way.
Yep, absolutely. Scott, thanks so much, and stick around. You're doing double duty for us tonight, and we'll see you a little bit later in our program.
Okay.
Now to another hot topic, that would be drug prices. Johnson & Johnson revealed this week it's going to begin showing the list price of drugs in television commercials, starting with its popular blood thinner Xarelto. Those commercials will begin airing in late March. But is transparency like this a good idea, or will it just create more confusion about an already confusing issue? Joining us tonight, Robin Feldman, who is professor at the University of California, Hastings Law. Robin, thanks for joining us tonight.
Pleasure to be here.
This is something the Trump administration has proposed companies should do. Johnson & Johnson will be the first. What do you think? Good idea, bad idea?
Well, I give Johnson & Johnson a great deal of credit for getting out front. After the administration proposed its regulations, the industry had its own list of regulations. Johnson & Johnson's the first one to put it on the line.
Now, what will this do for the consumer? Will it help or hurt the consumer? Because you got to read all that fine print, correct?
The problem will be what actually is in the ad, and can anyone read it? I don't know about you, but I don't read all the fine print that comes through in those ads. If it's simple, if it's clear, the consumer may learn something about the prices that are out there.
But if they're going to list the list price, that really means nothing when you consider the different ways that we pay for drugs, whether the insurance companies involved, the different pharmacies that are involved, the pharmacy benefit managers. I mean, is it going to be a bit misleading to list one price or what you're expected to pay when you go to the pharmacy?
You're absolutely right. The question is, what numbers go into price?
Yeah.
The list price matters because many people do pay that list price. They pay it if they've got a plan in which they have to pay up to a certain amount before the plan kicks in. Many of us have those. Or they pay in coinsurance or other ways. Those are based on the list price. But that's not the only price that matters. Now, Johnson & Johnson has said they're also going to list a typical price. What's a typical price? A typical price may be something that you and I never see.
You know, the cynical part of me thinks that the insurance companies will just find a way around this, and prices will not benefit the consumer in the long run. What's the likelihood of that? How are the insurance companies going to handle the fact that there now will be a either list price or a typical price that the consumer can see?
So this alone will not bring prices down. It's a great proposal. Consumers should know what's out there, but it's going to take a lot of changes before you and I pay a different amount when we walk into the pharmacy.
We will see. Again, the commercials start airing late March. See what happens after that. Robin Feldman with the University of California Hastings College of Law. Thanks again for joining us tonight.
Thank you for having me.
It is time to take a look at some of today's upgrades and downgrades. Fiat Chrysler was downgraded to equal weight from overweight at Barclays. The analyst there calls the automaker's 2020 targets aggressive. The firm also cited disappointing NAFTA region sales. The stock fell about 2% to $14.93. Kellogg was downgraded to hold from buy at Pivotal Research. The analyst cites the company's disappointing earnings and weak guidance, which we told you about yesterday. The price target is $62. The stock fell a fraction to $55.36.
Archer Daniels Midland was upgraded to a buy from hold at Stifel Nicholas. The analyst says that the market is undervaluing that company's earnings growth potential. Price target is now $52. Shares rose a fraction to $41.76 today. Grubhub was upgraded to buy from neutral at Bank of America Merrill Lynch. The analyst said that recent investments in marketing should drive that company's growth going forward. Price target now $108, and shares rose more than 4.5% today to $86.08.
Still ahead, the average college grad has $30,000 of debt, but we'll show you one school that's trying to help out. Time now for our weekly market monitor, who likes stocks that he says are leading the digital transformation and names you should own longer term. This is his first time on the program. Joining us is Michael Lippert, portfolio manager of the Barron Opportunity Fund. Welcome, Mike. Nice to have you here.
Thanks for having me.
Let's get right to your picks. As we said, leading technology companies. Guidewire Software is the first one. Why do you like it?
Yeah, they sell software to the property and casualty insurance industry, a massive industry. This industry is still mostly on green screen technology, and they're going to the shift to modern digital software and interacting with their customers in a different way. Guidewire is dominant in this space. They've never lost a customer. It's very few businesses that can say that. And the shift to the cloud for them is very, very beneficial. Their deals will be 2 to 3 times as large as their current deals are today, and the profits will be at least 1.5 to 2 times. So the shift to the cloud is very beneficial to them.
And I'm seeing a trend here with your 3 picks tonight. The second one's very familiar, Adobe, but you mentioned the cloud, and that's where they are now as well.
Yeah, I think this shift has happened all across software, right? You don't have to load the software on your computer, manage it yourself. Now your provider like Amazon or Facebook is providing the software, the services, and the analytics to you. Adobe does the same thing, and they're participating in big trends, producing and distributing digital content, marketing and advertising over digital means, and they're one of the big players there. And you know what's incredible about Adobe is they're a very high margin business, and everyone at home knows this. They can turn almost 40 cents of each dollar of revenue into actual cash at the end, at the bottom line. That's really impressive. And
Microsoft is your last pick. You said you weren't quite sure that they were going to be able to transition and kind of reinvent themselves, but they managed to do it in your assessment.
Yeah, I think for a long time there was debate whether or not they would get out of the Windows and PC generation to the cloud generation. I think Satya Nadella, as the CEO, has really done that for the company. You've seen a lot of legacy software businesses, tech businesses, never cross. Microsoft has. They're now one of the two dominant players in the cloud, along with Amazon's AWS, and Microsoft's Azure business is still growing about 75%, and their total cloud business, which includes Office 365, is growing over 50%. So I think Microsoft has a long runway of double-digit growth and also generating great profits and free cash flow. Very quickly, we hear from so many money managers who like companies because of their participation in the cloud. How much is left in the cloud growth strategy, do you think? I really think we're in the very, very early innings of that. I think the way we could capture data, the way we could deliver software and analytics, we're just starting to move to the cloud. Most of information technology spending is still done the old way. And I think when you think about the transitions like this or the generations like this, this will honestly last 20 or 30 years. We're 5, 10 into it, so we got a long way to go.
All right. Mike, thanks so much for being with us tonight.
Thank you.
Mike Lippert with the Barron Opportunity Fund.
Well, there's trouble in Toyland, and that's where we begin tonight's market focus, because Hasbro reported profits that missed Wall Street forecasts, and its quarterly sales fell by double digits. CEO said today that Hasbro's business was disrupted by the liquidation last year of Toys R Us, but analysts still believe that this company has a promising pipeline of new toys for this year, and that seemed to cap the stock's decline. For a time today, Hasbro was down more than 10%, but it finished the day down about 1% to $89.39. Electronic Arts quietly released a rival to the wildly popular Fortnite game this week. EA said today that 10 million people have already played Apex Legends in the past 3 days. We should point out it took Fortnite 2 weeks to hit that same mark. Electronic Arts admitted that its decision to do a surprise, unannounced launch was risky, but so far it seems to be paying off. The stock rose 16% today to $97.60. And Goodyear's earnings fell below expectations, and sales were down 5% in the most recent quarter. The company blamed currency headwinds and weakness in Brazil and China, which offset growth in Europe. Goodyear fell about 9% today to $18.69. It touched a 52-week low in the process.
The aluminum parts manufacturer Arconic said it plans to spin off one of its two main businesses and slash its dividend. The move comes after Arconic rejected a $10 billion buyout, saying shareholders would benefit more from a restructuring. The company also abruptly replaced its CEO. Arconic was down more than 3% to $17.10. Sony is buying back its own stock for the first time ever, a little more than $900 million worth. It is the second major Japanese company to unveil a buyback this week. SoftBank made a similar announcement earlier in the week. Sony shares rose just about 3% to $44.29. Wells Fargo says most of its online and mobile banking services are back up and running. Smoke at one of its facilities yesterday prevented customers from accessing those services. The bank did say, however, that there are continued problems with direct deposits, and some credit card and mortgage balances are still not available. Shares were off almost 1% to $47.65.
For thousands of high school students and their families, the wait is on. Applications to the colleges of their choice have been submitted, and now fingers are crossed. But most are also scratching their heads about how to pay the price of admission. With America's student loan debt soaring, some new alternatives are cropping up. Scott Cohn is back with us now from West Lafayette, Indiana.
Savannah Williams is an education major in her third year at Purdue University. She knew going in the math was not on her side.
I'm going to be a teacher, and I won't make a whole lot of income in the future.
How to pay for her education without drowning in debt. Purdue offered an alternative. Instead of taking out loans, Savannah will pay a percentage of her income for 10 years after she graduates.
If I would have gone with a traditional loan, I would have had to pay it all off. Who knows how long that would have taken.
It's called an income sharing agreement, the latest attempt to tackle America's college debt crisis.
That crisis is massive, a $1.6 trillion drag on the economy, affecting people's ability to buy a home, buy a car, start a family for years after graduation.
Purdue's president says the program, now in its third year, shifts the risk away from the student.
Gives them certainty and some protection and safety. They're not going to have that much money borrowed, piling up compound interest, whether they're doing well or not.
If the graduate doesn't work, she doesn't pay, and if she does really well, her total payments are capped. 2017 graduate Charlotte Herbert, who got a job as a technical writer making about $32,000 a year, financed her senior year with the program.
I think it's a good balance between you have to pay for school and keeping people from decades and decades of unmanageable debt.
Purdue says it's the first four-year college to offer income sharing, but the concept is taking off elsewhere in higher education as well. In San Francisco, Austin Allred co-founded the Lambda School, which teaches computer coding, free up front in exchange for 17% of your income for 2 years if you make $50,000 a year.
If your job as a school is effectively promising a job, it doesn't make sense that a student pays you a bunch of money and it doesn't work out on the other side. Schools don't want to do that for obvious reasons.
It's too soon to tell if income sharing will be the way everyone pays for college in the future. The programs are unregulated so far, and they still leave graduates with an obligation, not that much different from student loans. But this is one way some schools are trying to bend the curve of the price of admission. For Nightly Business Report, I'm Scott Cohn in West Lafayette, Indiana.
In an age of high-tech combat, guess what's making a comeback?
I'm Morgan Brennan in Lima, Ohio at the Joint Systems Manufacturing Center. It is the last remaining tank factory in America, and it's experiencing a renaissance. We're going to be talking tanks coming up on Nightly Business Report.
The FDA chief is increasing the pressure on e-cigarette maker Juul and Altria. The agency is accusing the companies of not following through on their promise to combat vaping use among teens. The commissioner is calling on the company's CEOs to explain their strategy, and he also threatened to pull the products if more isn't done, something that he has threatened to do before.
So when you think of the modern military, you probably think cutting-edge technology, high-tech drones, precision targeting missiles. But there's an unlikely weapon that's making a comeback. Good old-fashioned heavy armored battle tanks. Morgan Brennan is in Lima, Ohio.
As we come up here, we have additional robotic welding machines up here on the right.
They come in as Rusties, battle-worn steel hulls dating back to the 80s and sent here to Lima, Ohio for a second life.
It's about a 5-month process by the time it arrives here and it's delivered to the Army.
New armor, new electronics, new capabilities. The upgraded 70-ton M1A2 Abrams tanks are an Army comeback story.
So 5 years ago, when this facility was down at the lowest production levels, the majority of that was foreign military sales. We relied heavily upon foreign military sales, and that actually kept this facility alive. They did an industrial base study and determined that we needed to make sure that this facility was operational to do exactly what we're doing right now with these tanks. So from that study came the funding out of Washington.
This facility, the U.S. Army Joint Systems Manufacturing Center, is the only remaining tank plant in America. Last year, the federal government allocated $1.5 billion for upgraded tanks, and this year, more than $2 billion. This plant, which is operated by General Dynamics but owned by the government, was turning out 1 tank per month as recently as 2016. Today, 6, and next year, as many as 34 per month.
Since 1980, the tank has been one of our franchise programs. It's a significant piece of our overall production. We have production on the tank, we have production on Strykers, and a few other vehicles that we're doing. It's a pretty significant portion of our business.
Enough orders have been guaranteed to take production into 2021, a big reversal from 5 years ago when the Army even considered idling operations. What changed? The geopolitical threats. And Major General Cummings, a high-ranking Army official involved in the project, says tanks will be crucial to military operations.
The Abrams tank is still the main platform that we have in our formation and our fights that we need when we fight any type of peer-on-peer adversity. We have other tanks and continue to have overmatch over those.
The renewed demand has been a boon for local jobs. 3 years ago, 300 people worked here. Today, that's doubled. and it's expected to reach nearly 1,000 employees by next year. It's significant for Lima, population 38,000, a manufacturing town that's lost an estimated 8,800 defense industry jobs since the mid-90s.
So this is a military modernization story. It's a manufacturing story, but it's also a people story. And in terms of that, the stakes couldn't be any higher.
I tell folks I take this personal because not only was I a soldier, I have sons who are soldiers. And, you know, luckily they've all come back from Afghanistan and Iraq safely. But everybody in this facility and everybody that works for me understands the end game. And that end game is soldiers will die if we make mistakes.
For Nightly Business Report, I'm Morgan Brennan in Lima, Ohio.
That is an amazing
increase
in the number of tanks. I mean, just the fact that the need is there. That they're reverting back to the good old-fashioned armored tanks, the Abrams. But that's an incredible step up in production that we're talking about.
It really is, and I know Morgan will continue to follow that story for us, so we'll keep you posted. Before we go, here's a look at the final numbers on Wall Street. The Dow was down 63 points, NASDAQ added 9, S&P 500 gained 1. For the week, all of the major indexes posted some small gains, and now the Dow is up for 7 straight weeks. And that will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend. Hope to see you again on Monday.